Namaskaram everyone, this is Nishanth Reghunath here and welcome to a new video from KYDU's Financial Management Bootcamp. In this video, we'll be learning about a very interesting, short and sweet chapter, and that is leverage. So this particular chapter comes under capital structuring decisions, and you cannot actually correlate this particular chapter to the whole module of capital structuring, because this as a standalone chapter itself is questioned for your examinations. So you can learn this chapter. This is very short, very sweet, very simple, and be assured that you will get, say, 4 to 5 mark or 4 to 6 mark questions for your examination. So before we head on to the structure of the study, the structure of the chapter, how the syllabus has been said, let me give you a small quick explanation so that you can understand what you mean by leverage. Imagine this is a rock, a boulder, and you are standing right here with both your arms out there trying to push it and move. Unfortunately, this thing is not moving. So you decide you will take the help of a tool or something. Okay, so you move a bit, and you place a rod, a metal rod with some kind of support. And what you do is you grab a hold of this and, sorry, my arms look weird, apply down force here. Correct. Now when you apply down force here, obviously another force works in the opposite direction towards this end, and this will help you move the boulder much more easier. Yes, see, this is like a similar example wherein you use a jacky lever to lift a car. Yeah, in order for tire maintenance, or say your tire gets punctured in your car, you need to lift the car, right? It's impossible for you to use just your brute force and lift it. Like, there might be people who can do that, but then the generic person will not be so comfortable in doing the same, correct? Now, what did you do here? You took a third party, outside resource or outside item, and used that to magnify your power. So you are here using your own force, which by on its own, you know you can't push the boulder, you can't move the boulder. So you took an outside resource. In this case, a lever. And with that, you achieve your objective of moving the rock. Correct? This is what you mean by leverage. The phenomenon by which you use an outside resource in order to magnify your own force so that you achieve your objective with ease. You achieve this with ease. Yeah, just like how you use a jacky to lift a car, which otherwise would have been impossible for a person to lift. Yeah, so use a jacky and just do the circular motion, like rotating motion, using the lever of the jacky, and slowly you are applying a little bit force, and the jacky lifts, pushes the car from the bottom, and the car is lifted. This is leverage. Alright, so using the help of an outside resource to magnify your own force. Okay, so as far as a business is concerned, to run a business, you need fund. A fund can come from the owners, or it can come from outside. That is third party. Owner's fund is what you call equity. An outside fund is what you call debt. Now, with this fund, you run the business and achieve your objective of returns to owners. Correct? That's your ultimate objective, correct? So in financial management, what leverage means is how you use a third party resource. That is how you use debt to fund your business and thereby achieving your objective, wherein you try to give maximum returns to owners. So how a small change in your capital structuring, how bringing in a third party fixed cost bearing capital instrument like debt can impact the return that goes to the owners. That is leverage. So here, the outside third party debt, this is the lever. Alright, the lever which comes at a fixed cost but makes it easy to run the business because they bring in fund. Yes, they add on to your capital. Yeah, so your capital, your equity is your own force. Now with your own force, the business is not moving. So you are taking some debt. Now you are moving the business. Clear? Yeah, understood the concept? Yes? It's that simple. Now, our syllabus of leverage or a financial management syllabus of leverage can be split into 3. Now the syllabus, the leverage, term leverage can be split into 3. First we have operating leverage, then we have financial leverage, and finally then we have combined leverage, which is nothing but a combination of operating and financial. So in order to explain this more, let me give you the basic premise of profit. We know sales less expenses or cost. Yeah, sales less cost equals profit. Correct? Yeah. Basic formula. But see, here there is not much specialization, or we are not digging any deep. We are just giving normal revenue minus whole cost, we'll get profit. But as a management accountant or as a finance manager, you would be very interested to know what all are the costs that are coming to the company. Yes. So we can basically split our cost into 2. One is variable cost, another is fixed cost. Correct? Now let me just change this formula a bit. I'm just moving this. Sales, moving this a bit more. Less variable cost will give you something. So sales less variable cost will give you something called contribution. Alright? Yes. Now I'm bringing this fixed cost in the formula. Less fixed cost will give you what we had previously, that is our profit. Will give us our profit. Okay. So this whole expenses I split it into variable cost and fixed cost. Okay. So sales less variable cost giving you contribution, less fixed cost giving you profit. Alright. Now basic split up is done. We can even split this up further. But before going to that split up, let me ask you a question. Why is contribution, this term called as contribution? Why? Do you know why? Most of the students that I've come across don't know why that term is called contribution. Like sales, yeah, you know what sales is. You selling and getting money. Variable cost is cost which is varying. Fixed cost is cost that is fixed. So each term has a meaning. But why is contribution, this particular term, sales minus variable cost, called contribution? Say my sales is 100. I have a variable cost percentage of 40. So whatever I'm selling, 40% comes as variable cost. So less 40%, 60 is what I'm getting as contribution. Correct. Say my sales is 5,000. I have variable cost percentage of 40. So 2,000 goes as my variable cost. 3,000 is what I'm getting. I'm selling at 10,000. I have variable cost of 40. So 4,000 is my variable cost. 6,000 is what I'm getting. Sorry, 10,000. Correct. Now what do you notice here? See, regardless of the amount you are having as sales, for sure 40% of it will go for variable cost. That is, if I am achieving sales of X amount, 40% of the X amount is for sure an expense of mine. Correct? I cannot recover that cost. It is gone. It will be definitely gone. So whenever I'm saying I'll achieve sales of 1,000, I'm not getting money for 1,000. I'm sure out of that 1,400 will go. I'll get 600 to meet by rest of the expenses and take profit. Yes? Correct? So when I'm selling for 100, 40 will not come to me. 40 will be gone. But 60 will come to me, with which I can meet my other expenses and take my share of profit. Correct? So when a sales is made of 100, the actual money that sales contributes to the business to meet other expenses and for me to take my profit is 60. So 60, 3,000 or 6,000 is what the sales of 100, 5,000 and 10,000 respectively contributes to the business, so that the business can take that contribution, whatever that sale contributes, and meet their expenses and take the balance as their profit. Correct? So it's out of this contributed amount, they have to meet all their fixed expenses, they have to pay their taxes, pay their interest expenses and everything. And if there is any balance, take that profit and split it among their shareholders or owners. Yes. Now this is why this particular term is called contribution. That is the amount the sales or revenue of a company actually contributes to the business so that the business can meet their fixed expenses and their share of profit. If at all, if there is any balance, then give a share of profit to the owners. Clear? Simple. See, now I'm going to bring up a further split up. See, this fixed cost, I can further split it up into operating fixed cost and non-operating fixed cost. If I'm to give an example, an operating fixed cost will be something like depreciation. Alright, because that is depreciation comes for assets that you're buying for business, and assets are bought for operations, and you pay depreciation as an operating fixed cost. Non-operating fixed cost can be something like interest that you pay. You borrow money, you pay loan, interest. Correct? So I'm going to restructure this whole formula once again. Oh, sorry. Selection. Taking fixed cost aside. Taking this apart. Don't want this. Now what I'm going to do is I'm going to post operating fixed cost first. Oh, sorry. Operating fixed cost first. Contribution less operating fixed cost will give me my earnings before interest and tax. And I told you non-operating fixed cost is nothing but interest. Yes, generally we can term it as interest. Okay, it's interest. We'll consider it as interest. So here, no, sorry, your non-operating fixed cost, when you deduct from your EBIT, will give you your profit. Correct? So let me just move this guy a bit up. Come up. Yes, simple, right? So I further split the formula. I further split fixed cost into operating and non-operating and reached two other levels. So sales minus variable cost, you get contribution. Contribution minus operating fixed cost, you get EBIT. EBIT minus non-operating fixed cost, you get profit or earnings before tax. Clear? Yes. Now let me put some numbers here. Say my sales is 1000. My variable cost comes at 60%. So it's 600. So my contribution is 400. Correct? My operating fixed cost, let it be 100. So my EBIT is 300. And finally my non-operating fixed cost, let it be 200. So my profit is 100. Clear? Yes. Now I'll show you what are the different kinds of leverages. So we'll use three colors. Let operating leverage be in blue, financial leverage be in green, and combined leverage be in red. So let's first do operating leverage. In operating leverage, all the leverages are like a formula, a division formula with a numerator and a denominator. In operating leverage, the items that you take from this particular area. So for all leverages, this is all that you need. Okay. So here you take contribution and EBIT, and thereby operating leverage is calculated. Contribution divided by EBIT. For financial leverage, you take EBIT and EBT. So it is EBIT by EBT, thereby calculating financial leverage. So here what would be your answer? 400 divided by 300 is 1.33 times. And here it is 300 divided by 100. 3. Correct? Now combined leverages contribution and EBT. Contribution and EBT. Combined leverages contribution and EBT. That is 400 divided by 100. 4. So what is combined leverage? Contribution by EBT. It can also be written as combined leverage equals operating leverage into financial leverage. Oh, this was not C. This was supposed to be. I'm sorry, I made a mistake here. This is not C. This is financial leverage. Okay, financial leverage. Sorry for that. Yeah. Combined leverage is operating leverage into financial leverage. What is operating leverage? Contribution by EBIT. And financial leverage is EBIT by EBT. So you cancel off both EBITs, you'll get C by EBT. C by EBT. So if you take 1.33 and 3, multiply them. If I'm taking 1.33 and 3 and I multiply them, let me just give the calculator. There is a calculator. Yeah. 1.33 3 into 3, correct? 3.99, that's 4. Yes, this is a decimal difference, correct? So combined leverage is nothing but operating leverage into financial leverage. Understood? Basic stuff, right? Basic stuff. This is all. What do you mean by leverage? Okay, so you got all the formulas. Once again, I'll repeat. Operating leverage is contribution by EBIT. Financial leverage is EBIT by EBT. Combined leverage is contribution by EBT or operating leverage into financial leverage. Alright, simple stuff, simple stuff. Now I'll tell you what's the relevance of this particular item called leverage. Okay, so I told you, right, how using debt, how using this outside third party will affect our objective, how easily we'll affect our objective, and how we can increase the return to our owners. Yes, so I'll show you how. Say operating leverage is 1.33, right? So I'll write in blue. What does operating leverage communicate? It communicates that if sales move up or down by one time, then your EBIT will move up or down by 1.33 times. Okay. So you might have a confusion here. See, here we establish relation between contribution and EBIT. So it should have been if contribution moves, then how will EBIT move? That's how it should have been, correct? But here I wrote if sales move, then EBIT will move like this. Why? Why is that? I'll quickly explain. See, what you're seeing right here is, I'll just take this off for now. Sorry. See, what you're seeing right here is the exact same data, but I've given it like multiple instances. So we'll just take this one. We'll just take this one for example. Okay, we'll just take this one for example. So sales is 1000 here, variable cost 600, contribution 400, everything as mentioned. So look at these examples, like the D column, E column, F column. Here sales moved to 2000. Here sales moved, dropped to 500. Here sales moved to 5000. So here sales grew 2 times. Here sales dropped by 0.5 times. Here sales grew by 5 times. Correct? See what happens to contribution as well. Contribution also move in the same direction. So sales moved 2 times from 1000 to 2000. Contribution moved 2 times from 400 to 800. Sales went down from 1000 to 500. Contribution went down from 400 to 200. Same. It went by half. Sales increased 5 times from 1000 to 5000. Contribution increased 5 times from 400 to 2000. Clear? Simple stuff, right? Simple stuff. That's it. That's why I said contribution and sales move in the same direction. Contribution moves 1 time, that means sales has also moved 1 time. Sales becomes 3 times, that means contribution will become 3 times. Because contribution, variable cost and sales, they move all in the same direction. Alright? Yes, fine. Alright, so let me just clear this page. Now, financial leverage tells that, financial leverage tells that if EBIT moves up or down by 1 time, then EBT will move up or down by how many times? 3 times. Okay? Clear? Now finally, combined leverage. So combined leverage is contribution divided by EBT. Contribution divided by EBT. So numerator is contribution, so we can link it to sales. So if sales move up or down by 1 time, then EBT will move up or down by how many times? 4 times. Correct? Simple, right? Now I'll give you a quick explanation using multiple examples based on the same example. Okay, let's go back to our Excel chart. Okay, so here is our Excel chart. Oh, sorry. So just take this and take it to another page. New page. Zoom this a bit. Okay. So this is sales less variable cost. My mouse is glitching. Sales less variable cost. Okay. Sales less variable cost equals contribution. This is less operating fixed cost. Less operating fixed cost will give you EBIT. Less non-operating fixed cost. Less non-operating fixed cost will give you EBT. So from here we can find out our operating leverage, financial leverage and combined leverage. Operating leverage is nothing but contribution divided by EBIT. 1.333. This is EBIT divided by EBT. 3, and this is finally contribution divided by EBT. 4. So we know what it means by these figures, right? Operating leverage of 1.33 tells us that if sales move by 1 time, then our contribution will move by EBIT will move by 1.333 times. Yes, so let's check. So I'm going to move sales by 1 time. So by moving sales by 1 time, I mean, so 1000 is the sales currently. I'll move sales with another 1000. So sales will go to 2000. So 1000 into 2. 1000 into 2. Sales is going to 1000 into 2. Oh, okay, small. 1000 into 2. So sales become 1000 into 2. So variable cost 60% will be 1200. Contribution is a balance. I have given formula here. Variable operating fixed cost will not change. It will be 100 itself. So if you are wondering how the 1200 and 800 came, sales 2000, variable cost is 60% from our question. So 2000 60% is 1200. 2000 minus 1200 is 800. Less operating fixed cost 100. So your EBIT will be 800 minus 100. That is 700. Correct? Now let's check whether EBIT has moved based on 1.33 times. Let's check. So what was our EBIT? Our EBIT was 300. Correct? But it's supposed to move 1.33 times. Let's see what is 1.33 times of EBIT. 300. 1.33 times of EBIT is 400. So what is 300 plus 400? 700. Check. Did EBIT move accordingly? Yes, most certainly. EBIT moved accordingly. Yes. Now, non-operating cost same, and your EBT becomes 500. Now, we can either check with financial leverage or combined leverage. Let's first check with combined leverage. With combined leverage, it said if sales move by one time, combined leverage says EBT should move by 4 times. EBT should move by 4 times. Okay, let's take our EBT. We'll take our EBT. What is our EBT? It's 100. What is 4 times of 100? It is 400. It's 400. So what is the answer that should have come here? Should have been 500. Is our EBT 500? Yes. See how our EBIT and EBT moved. Now if I'm taking financial leverage, let's take a stock on the base of financial leverage. So it says when financial leverage moves 1 time, EBIT moves 1 time, my EBT should move 3 times. Correct? If EBIT moves 1 time, my EBT will move 100 times. So let me just scroll down a bit. If EBIT moves 1 time, my EBT should move 3 times. That's what this says, right? So EBIT, EBT. But here EBIT moved how many times? Here EBIT moved how many times? EBIT moved from 300 to 700. EBIT moved 1.33 times. So EBIT moved 1.33 times. So how many times should have EBT gone? Should have been this into this divided by this. Basic cross multiplication. 3.99 times. EBT should have gone 3.99 times. Okay. Yes. That is 4. We can term it as 4. So let's just check EBT. EBT was 100. How much did they move? 100 into 3.99. That is like we can. That's basically because of the decimal issue. Else it would have been proper 4. So it stood at 499. It would have been 500. Same. Okay. So if I'm like ignoring the decimal here and making it like 1.33334. Yeah. minimizing the decimals. Perfect. See? So in short, it says if sales, I'll go down. Sales move by 100%, if sales move by 1, EBIT will move by 1.33, EBT will move by 4. Correct? Correct. Now if I am to express all this as percentage, this all percentage, where is percentage? Percentage. We can work this out far more easily. Say for example, I need to increase my sales, say 152%. Okay, I'm increasing my sales. This is my, imagine this is my 100% sales. Okay, 100% sales. I want to increase my sales to 250%. 250%. So my sales is 1000 into 250%. So it becomes 2500. Correct? What will be my EBT? What will be my EBIT? I do not have to do the whole calculation. I can do it super simple here. So if my sales move to 250%, sorry, let me just change the format everywhere. Okay, sales move by 250%, then my EBT will be, the change in EBT will be 250. So my sales is going to 250%. As in not 250%, it's increasing by 250%. So increase by. So my sales increased by 250%. So my current sales is 1000. With a 250% increase would mean 1000 into, that'll give me sales of, prices in percentage, I don't want this in percentage, I want in general. Yeah. With my sales will go to 3500. If that's the case, my EBIT will increase by how much? My EBT will increase by how much? So it said, when sales go up by 1 time, EBIT will go by 1.33 times. So sales went by 250%. So if I'm writing, if sales go up by 1 time, EBIT, wait, small glitch, okay, sorted. My EBT will go up by 1.33. So if sales increase by 250%, EBT will increase by 1.33 into 250%. Correct? So here it will be 250 into my operating leverage of 1.33. That will give me 33.33%. Now, my combined leverage says, if sales go by 1 time, financial leverage says, if my EBIT goes by 1 time, my EBT goes by 3 times. So, EBIT go by 1, EBT go by 3. Correct? So here EBIT went by how many times? EBIT went by 1.33 into 250 was 333%. 333%. Right? EBIT went up by 333%. That is this one. Yeah. So EBIT went by 330%. So EBT should go 3 times of that 333. So 3 into 333.33%. So that will give me EBT increase at 333 into 3. 1000%. Oh wow. 1000%. We can confirm that in another way as well. From financial leverage, if sales go by 1, my EBT should go by 4. EBT should go by 4. Let's check. Sales go by 1. It says sales go by 1. EBT should go up by 4. That's what it says here, right? We'll just scroll down a bit. Yeah. Here actually my sales went up by 250%. So my EBT was supposed to go up by 4 times of 250%. That is 1000%. Cross verified. Correct. Now let's confirm whether our finding is right or not. Okay. So here, my sale is 3,500. My variable cost will be 60% of the same. So it's 2,100. Contribution in 1,400. Sorry. Less operating fixed cost of 100 will give me an EBIT of how much? 1,300. So EBIT definitely went up. It went from 300 to 1,300. It went up from 300 to 1,300. Less. So what was the increase that was supposed to happen? 333% was the increase that was supposed to happen. Correct. 333% was the increase that was supposed to happen. Let's check. What is the increase that actually happened? Increase happened was 1,300 minus 300. Yes. Now let's check the percentage. This divided by this into or 100 into 100. 333%. Correct. Exact. Or you can do that in another way as well. Another way is take this and find its 333%. 333%. And add it. 300 plus 333%. Not exactly 333%. It was supposed to be, there's a decimal, right? It was 330 point something percentage. Yeah. See? So it became 1,000. The decimal rounded off the 999 to 1,000. See? So yes, when sales increased by 250%, EBIT actually increased by 333%. Correct. Now let's check the same for EBT. So non-operating cost is 200 and your EBT is 1,100. What is the supposed increase for EBT? 1,000% increase, right? 1,000% increase. Let's check. This into 1,000% will give you this into 1,000% will give you how much? Will give you 1,000. So this plus 1,000 will give the increased figure. Yes, see? Same, correct? This and this is the same, correct? So when sales increase by 250%, EBT increase by 1,000%. Now, I'm going to add another one, increase by some stupid figure, okay? 336.37%. So if sales is, here, 36. So it will be 0.3637 expressed as percentage will be 36.37%. If that's the case, why isn't it coming out? 36.37%. If that was the case, then my EBIT should be this into my operating leverage. What is my operating leverage? Into 1.33. Okay. So this expressed as percentage will be 48. Taking out decimal. Now this should have been sales this into my combined leverage. Combined leverage is 4. Now this also I'm expressing as percentage. So this expressing as percentage. Okay, with 2 decimals. Now to cross verify, we can do it like this. If EBIT moved by 1, I'll take another pen. EBIT moved up by 1, EBT should have moved up by 3 based on financial leverage, right? So I'm just going to confirm here. EBIT moved by how much? 48.49%, correct? So EBT should have moved by 3 times of 48.49. Let's check what is 3 times of 48.49. Let's write it here. This into 3. It should be 145.48. Yes, see, if I'm expressing it as percentage, see, same. That's simple. Alright. So this is why you need leverages. So that when you take a random sales figure or you want to project to a company saying that our sales is currently 10,000, it will go to say some 25,000. That is an increase by 150%. Or it will go to say 75,000. That is an increase by 65%. Then we can expect our EBIT to go up by so much percentage and EBT to go up by so much percentage. Okay. Yes, clear. That's it. That's why you need leverages. Okay. Think I've covered everything that's required as far as the theory area of leverages are concerned. Okay, one more area. Just one more area. See, a high operating leverage means you have high operation fixed cost. I'll tell you why. Say my sales is 1,000. My variable cost is 200. So my contribution is 800. Let me just scroll down a bit. and my operating fixed cost is 600. So my EBIT will be 200. So here what is my operating leverage? It's 800 by 200, that is 4 times. Correct. Now instead of 800, 600 and 200, and let me give another area. Contribution is 800. My operating fixed cost is just 200 and my EBIT becomes 600 then. 800 minus 200, 600. Here what will be my operating leverage? Will be 800 by 600, that is 1.33. So my operating leverage went down here, that is because my fixed cost went down. But when my fixed cost was very high at 600, my operating leverage was high at 4. So high operating leverage means high operating fixed cost, and just like that, high fixed leverage means high non-operating fixed cost. So you will get questions like this in your examination, 1 word or 2 mark question. A company has very high operating leverage compared to last time. This year a company has very high operating leverage compared to last year. What does that signify? You'll have options. Option A, your fixed cost has gone up. Option B, your variable cost has gone up. Option C, your non-operating fixed cost has gone up. Option D, your operating fixed cost has gone up. So you need to choose your operating fixed cost has gone up. Alright, understood? So is pretty much it for leverage theory. Is there anything left for me to explain? Nothing, yeah, that's all. So I hope you got a really good understanding of this study. In case you have any doubt, please feel free to reach out. And also, as I always say, if you like my content, please show me some love. Like, share, subscribe, comment your thoughts, bring in more traffic to my small channel, and that would do a great deal of help in my growth as an online educator. So with all that said, this is Nishanth Reghunath signing off and thanking you. Bye bye and see you in my next video.